So just to preface, Dividend Aristocrat is a company that's been paying a dividend, has increased that dividend for 25 consecutive years. A Dividend Keen, same story, except they've been doing it for 50 years. So there are websites out there you can go to and see lists of Dividend Aristocrats, Dividend Keens. They'll update them every month, day, week, however long they do. So that's shouldn't be too difficult. You can just Google Dividend Keens or Dividend Aristocrats, give you a list of ideas. The question behind whether do I research these companies? Of course I do. Do I focus on them? Yes and no. And so, you know, it's a great thing to see a company with a track record of growing dividends. Generally, that's a good sign, but it needs to be done in a way where this company grew, they were profitable, they grew profits, they grew dividends, and they did all of that together. You don't want a company in a situation where they're, as an example, getting a bunch of debt in order to pay a dividend, or their business is going down but their dividends that they're paying are going up. That's not sustainable. At some point it's going to break. And so, if you look at a company, if you've been a loyal customer to Amazon for 5 years, does that guarantee that you'll give them your business next year? I mean, maybe it could influence that a little bit, but if they start dropping the ball and giving you packages in 2 weeks instead of 2 days, then maybe you switch to a different retailer. And so, in the same token, businesses can have great times where they execute really well, but they need to continue executing. And so that's where kind of being cognizant of what's going on with these companies comes into play. So it's a great place to look for ideas. I don't think anybody should just focus solely on them, because they can give you great returns, but it's not always those group of stocks that do the best. Even though some articles online will try to claim that, it's not going to be true all of the time.
Yeah, one of the, I guess, difficulties or struggles with investing in companies like the Dividend Aristocrats or the Kings is you have to look at the life cycles of businesses. And generally, companies that are paying dividends that are in that nature of 25 to 50 years are more on the mature side of their growth, if you will. And the thing you have to kind of think about is, I'll just kind of pick on a couple companies here. So Coca-Cola and Johnson and Johnson, who are probably the two or the more famous dividend aristocrats, their returns over the last 5-10 years have been kind of And so, and especially if you compare that to the returns that the S&P 500 has gotten over that same period. Now, yes, they're conservative companies. Yes, they are paying a great dividend and it continues to grow. But the other part of the business is investing into business, not just the dividend. And so the thing you have to think about with a company like Coca-Cola is, as much as I love the product, and I drink a lot of it every day. And so I may not own the company, but I am certainly contributing to their bottom line. The issue though is that if I invest in Coca-Cola, that's money that I'm taking away from investing in something else that could earn me a better return, albeit maybe at a lesser dividend yield, but it could be I could a comparable dividend yield. Let's say, just for numbers, let's say Coke is paying a 3% dividend yield. I don't know if this is the actual fact. I'm just throwing out examples here. So let's say the Coke is paying 3%, but the overall return of the company is 3.5%. So now you're looking at around a 6.5 to 7% return total for investing in Coca-Cola. Let's say that I find a company that's only paying me a 2% dividend return, but the stock is actually returning 8%. So now I'm looking at a 10% return for that company versus the 6 or 7 that I could get with Coca-Cola. Well, I don't know about you, but I would rather choose the latter over Coca-Cola. And it doesn't mean that I think Coke is a bad company or a bad investment. I'm just looking for, if I want a better return, I want to go for the company that's going to, in theory, give me a better return. And so when you look at the companies that comprise all of the dividend aristocrats and kings, most of the, well, they're companies that have at least have been around for 25 years because they just have to by the nature of the name. And then some of them have been around for 50 plus years. None of them are going to grow like Microsoft is now, or like Amazon or Google, or even picking companies outside of that whole realm, even Berkshire Hathaway. They're not going to grow like that company is, just because of the nature of what they do and how they do it. And it's just an economic fact. And so you have to think about, what do I want to get from my investments? And maybe for a little bit more risk, you could buy something like a Visa or MasterCard, just as an example, and you could get a better return than you could buy from getting Coca-Cola, even though Coke gives you a better dividend. So those are just things to think about, I guess.
I've I'm gonna fight back again, and
Okay.
don't take this the wrong way.
I'm not.
Practice your thick skin. It has nothing to do with anything you're saying. This is just stuff that's been circling around my head a lot lately. So the thing with the life cycle, I think this is important to understand, because when you're jumping into the stock market, you need to understand what there are positives and negatives to investing in the life cycle. So you mentioned the life cycle. I think it's a really important thing for new investors to kind of understand. You basically have the birth stage, the explosive growth, and then the maturation. And so when you're going in the explosive growth stage, the reason why a company can get explosive growth is because it's either a brand new market, it's a brand new product, brand new service, and so the number of people who are using it are just exploding leaps and bounds, or it's coming in completely and just destroying another business. So like Netflix would be a perfect example. They destroyed Blockbuster, and so they were able to go explosive growth because they had a really small company, and then they grew it as they took everything Blockbuster had. Now you look at Netflix, and they might start to get towards more of that maturation, where they're not going to explode like they used to, because there's no more Blockbuster to take from. Blockbuster's dead. And so really what's going to limit their growth is going to be the number of people that are in the world and how much they're willing to pay for Netflix. And so what's nice about being in the maturation phase and investing in companies like that is that as long as they can keep those prices going, they could be a cash cow for decades. And Coke is a good idea, a good example of a company who did that uh, 20, 30 years ago, and they were able to do it for many decades. And now it's kind of starting to die off in a way. You can just look at their revenue numbers and you can see it as it's going down. That's a good sign of a company that's really gone from maturation into kind of decay. And so when you look at companies, you do have companies that are kind of maybe decaying when you look at the revenue, like Coca-Cola or Johnson Johnson. You also have another company like Target, which I'll say I've been a shareholder of for a while. I recommended it for the e-leather. Over the last 40 years, if you've invested stock, if you bought a share of Target stock 40 years ago, you would have had a 24% annual return if you reinvested your dividends. And so this is a stock that, if you look at it on the surface, they look like they're matured. They have 1,900 stores, and they're not really looking to grow past that. Most of the US already has a Target. But if they can continue to serve the kind of customer that they have and give them better products at higher prices every single year, then that allows them to be in that sweet spot of maturation, and it allows for nice dividends, nice dividend growth, and nice earnings growth. You kind of get everything that Dave was saying. With, you might get a lower yield because a company like that might be a little bit more expensive, but you get the growth that comes with that. When you add that to the yield, you get a much better return. And so what I like about picking stocks that are in that maturation phase instead of in that explosive growth phase is that they already have their dominance. So all they have to do is continue to execute. They don't have to spend a bunch of money to try all these new things and try to make a name for themselves. They've made the name for themselves. All they got to do is continue milking that cash cow and basically just not have somebody to come in and screw it up. Now, sometimes another business can come in and try to screw it up. That's where the moat comes in. We've talked about economic moats before, and you can go back in the archives and listen to that. But really, it's their game to lose at that point. And so that's where a Dividend Keen or Dividend Aristocrat can be a great company, because those, if it's a company that's in that sweet spot of maturation and they're living the good life in there, that can be a great investment for a very long time.